Why this is one of the riskiest moments of the 21st century. March 29, 2026. Nowhere to run, nowhere to hide. As the US-Israel conflict with Iran entered its third week, financial markets remained under pressure, leaving investors with few safe havens. Stocks declined for a fourth straight week, while traditional defenses such as bonds and gold failed to provide protection. Cash, particularly US dollars, emerged as the only reliable refuge. The main driver of market stress is the surge in oil prices, which has complicated the outlook for central banks. Rising energy costs are fueling inflation concerns and shifting expectations for monetary policy. Before the conflict began on February 28, markets anticipated 2 Federal Reserve rate cuts by year-end. Now, there is even a 1 in 3 chance of a rate hike. Reflecting this shift, the 2-year Treasury yield has risen to 3.89%. Despite this change, the Federal Reserve has kept its benchmark rate unchanged at 3.50% to 3.75%, while still projecting a possible single rate cut later in the year. Policymakers remain cautious due to uncertainty surrounding the conflict. Other major central banks have taken a similar approach. The European Central Bank, Bank of England, and Bank of Canada have held rates steady, while Australia has raised rates again to counter inflation. Before the conflict, expectations of monetary easing had helped push U.S. stocks to record highs. The S&P 500 has since fallen about 7% from its peak, a relatively modest decline given what has been described as the largest oil supply disruption in history. Oil prices remain central to current risks. Brent crude has surged to as high as $119 per barrel, raising concerns that energy costs could spill into broader inflation. At the same time, history shows that sharp oil price increases often precede recessions, creating a difficult challenge for central banks balancing inflation control with economic growth. Economists say the Fed would only consider raising rates if certain conditions are met, including low unemployment, steady job growth, and signs that rising energy costs are spreading across the economy. However, if oil prices rise further, especially above $100 per barrel, it could threaten the labor market and push the economy toward recession. Some analysts warn of a danger zone where inflation rises while growth weakens. For now, markets appear more focused on inflation than recession. This is reflected in rising Treasury yields, with the 10-year reaching 4.39% and the 30-year nearing 5%, both at multi-month highs. Higher yields have also weighed on gold, which has fallen sharply as investors sell assets to cover losses elsewhere, though it remains up for the year overall. Looking ahead, developments in the Middle East and their impact on oil prices will continue to drive markets. Although leaders suggest a quick resolution, uncertainty remains high. Some strategists believe stocks could recover if corporate earnings stay strong. However, rising gasoline prices approaching $4 per gallon pose a serious risk. Past spikes to this level have contributed to stagflation and major market downturns, including in 2008 and 2022. With central banks unlikely to cut rates, credit markets under strain, and inflation pressures rising, the global economy faces a highly uncertain environment described by some as one of the riskiest moments of the 21st century. By Barron's story by Randall W. Forsyth.